But let's get a move on and focus in on earnings and Affle India. So a 3 times rise in their net profits for the quarter gone by, with consistent growth in their ad spends and revenues doubling. Anuj, Khanna, Sohum, who is the founder and chairman at Affle India, now joins in to talk a little bit more about their quarterly performance as well as the outlook going forward. Good to have you on board. Let's just take a look at your earnings, and your profits have shot up 73%. And that's been strong. There's been strong revenue growth. EBIDTA growth as well has been healthy. What has led to this performance?
Yes, Affle has done exceptionally well in this entire financial year, as well as in Q4. The results were phenomenal. And we had promised to our shareholders in the last earnings call that we will deliver 3 centuries by the end of the financial year, which we have delivered. First one being over 100 crores. We delivered over 103 crores of PAT. We delivered over 103 crores of cash flow from operations and over 105 million conversions with converted users. And that's really quite fantastic. And I must thank my team of all Afflers who have stayed through very resiliently through the COVID times. It was the toughest financial year, and I think we have come out the strongest. And the impact on profitability or EBIDTA is simply a function of scale. We are a asset-light, highly scalable tech platform company. So as we continue to grow our revenues, both organically and inorganically globally, we would continue to see the impact on increased profitability, EBIDTA, and most importantly, we are realizing our profit after tax into cash flows almost 100%. I think you can see that in the whole financial year, 99.9% conversion of PAT into cash flows. That shows the quality of business and the faith that our customers are continuing to show in the platform and our business model.
Talk to us a little bit about the trends in the CPCU and the non CPCU business, particularly how growth is shaping up because CPCU has seen very strong traction.
Absolutely. See, we are a consumer platform company. We work with app developers, marketers, brands around the world to help them on their mobile first strategy, to reach out to consumers on their mobile smartphone connected devices around the world and help those consumers to actually see these engagement not just as ads that show up, but actually as consumer recommendations on their devices, in-app experiences, and so on. When the consumers engage with these ads and go well beyond engaging with it and do deeper ROI-linked conversions with the advertisers, that's when we make money. So almost 98% of our revenue, more than 98% of our revenue comes from the consumer platform business, within which over 85% of the revenue comes from cost per converted user business model, which is deeply ROI linked for the marketers, app developers, and the brands. And that business has done really well in the last financial year. There are 2 ways that you would analyze this business. One is volume. How many conversions have we delivered? And there we did over 105 million conversions in the last financial year. The second thing that you look at is what was the unit price per conversion, the CPCU rate at which the conversion happened. And there we have been quite resilient at 41 rupees approximately. I think 40.9 rupees is what's been reported as the average cost per conversion. When you multiply these 2 metrics, the volume, the scale, and the unit economics, the unit pricing, you find that almost 85% plus of our revenues is derived in that basis. And we've seen phenomenal growth in India, as well as all emerging markets, Southeast Asia, Middle East, Africa, and also increasingly in Latin American markets. So we are seeing all-round growth from existing new customers. We are seeing all-round growth from existing markets, new markets, and that's been really powering the CPCO business growth for us.
Right. Anuj, how has COVID impacted your business though overall, especially if you're seeing any specific customer trends or business trends during the second wave?
Yes, definitely. We have seen that, throughout this financial year. In fact, before we entered this financial year, we already entered with a lockdown, a massive lockdown in India, which happened towards the latter half of March in 2020. So this entire year has been clouded with the backdrop of COVID, which has definitely not been pleasant. It's been fairly challenging on multiple fronts. Personally, for me and for my team members, there have been losses in the families of most of the team members. We have had losses. I mean, one very unfortunate loss of life for one of our team members in India. And this has been extremely sad backdrop. But on the other hand, ironically, what we have seen is that the consumers and all of us as individuals have become deeply dependent on our mobile and smartphone connected devices for every kind of lifestyle need, whether it is entertainment, education, e-commerce, healthcare, financial banking services, food tech, and so on and so forth, even government related matters. So our business, over 90% of our business has come from categories E, F, G, and H, which we have enumerated multiple times. And these are all lifestyle services categories that the consumers are heavily dependent on, especially when they can't go out or when we have to stay within our homes and work from home situations. So this has actually been a blessing for our business. Ironically, we have done extremely well with the backdrop, which is personally and professionally quite challenging, but from revenues and the scale that we are seeing in our business, on both sides, the consumers on one side are using a lot more of their mobile devices to adopt onto these services. On the other hand, the advertisers and businesses are clearly realizing that in these times, mobile marketing and digital marketing has to be embraced like never before. So the trends that we are seeing are that the consumers are in a multi-year systematic shift, not just in urban segments, but also in rural areas, well beyond tier 2, tier 3 cities, all the way to rural India. The adoption of mobile and digital is clearly accelerated because of the COVID situations. And similarly, on the advertisers and businesses, whether they are large global conglomerates or they are much smaller SMEs, all of them are needing to embrace digital and mobile marketing. And therefore, these two mega macro sort of factors are helping and providing a massive tailwind to our business and its continued growth and momentum. And I believe this will continue to last us for next 3 to 5 years. And therefore, we are very optimistic and bullish that in terms of our business growth, we can deliver sustained cash flow positive, profitable growth in our business, anchored on our customers spending more and our consumers transacting and converting increasingly more through these smartphone connected devices.
Right, you already preempted my question. So you do expect strong business momentum to actually continue, given that you've already reached profitability of slightly about 100 odd crore rupees and revenues of over 500 crore rupees in FY21. What's the kind of growth that you expect for the next 3 to 4 years?
Sure. See, I've always consistently maintained ever since our IPO and even pre-IPO that our company would deliver sustainable growth, at least 25% CAGR growth over a 5-year period of time. And as the base of our business continues to grow, I have always maintained that even with that increased base of our business that we are at now, which has substantially grown in the last 2 years, this commitment to deliver at least 25% to 30% CAGR growth over the next 5 years is something that our team of passionate entrepreneurs and leaders is very, very committed to. So we are very confident that the business trends with COVID and also even without COVID, I think the writing was already on the wall that digital is the future, data-driven marketing is the future, ROI-linked marketing is the future. So all businesses will clearly embrace it. I will also give you one other data point that will help your viewers. India as a market is almost 50% of Affle's revenue, and the remaining 50% is largely anchored on other emerging markets. If you look at how much percentage of total advertising that is spent by businesses on mobile marketing today, that's about 20% of the total marketing budgets. It is safe to say that in the next few years, all businesses will upgrade their digital and mobile marketing to almost 50% of their total advertising spends. That has already happened in developed markets. Across emerging markets, this will definitely happen in the next 3 years or so. And this will give us the continued momentum to deliver significant growth that we are already talking about, which is 25 to 30% CAGR over the next 4 to 5 years.
Okay, so some of those, key trends, as you said, that have been consistent now over a while. Now, you recently raised money via QIP. Last year, we also saw you making certain investments. What continues to be the strategy there going forward?
Sure. If you would notice in this month of May 2021, we raised over 600 crores for Affle India through QIP. And I must thank all our institutional investors who have come from India as well as overseas foreign investors who are long-only investors who have come in and supported this QIP success. This means that Affle today has the strongest balance sheet than it ever had in the last 15 to 16 years. And this balance sheet strength that we have with the funds that we have raised from the investors will definitely be applied very carefully, very calibratedly for inorganic growth plans of the company. And we have a massive track record on inorganic growth. You would see in the last several years, we've been extremely successful in demonstrating that Affle has the ability to identify the right targets, do the right deal mechanisms to integrate them, and to turn them into profitable businesses as we scale our organization. So with that track record, with the fact that our balance sheet is much stronger than any time before, we are very, very convinced that we will be taking very calibrated and carefully evaluated steps to support the inorganic growth plan. And that should unlock, substantial global growth for us going forward.
Okay. And within these investments, would there be any specific businesses you're looking to acquire?
Sure. There is only two tracks that we're looking at. One is emerging markets focused global expansion. So building teams in each of those geographies can be a very slow process. Whereas if we find the right target company with the right culture, right technology and people and customers, and if we find the deal mechanisms to be appropriate, we will certainly do inorganic expansion to grow our presence in new geographies. So Latin American markets, and even looking at those as launch pads into maybe North America and so on. So that is one track, like global expansion. The second track is going deeper with our vernacular and verticalization strategy into existing markets like India. How do we go deeper on our vernacular verticalization strategy? How do we go deeper in our operator and OEM partnership strategy, which we have been consistently talking about? So if there are any interesting opportunities there, we will double down and invest in those opportunities on a consistent basis.
All right, Anuj, thanks so much for joining us and taking us through all the latest there.